ESG, or environmental, social and governance factors, refer to the non-financial factors that one has to take into account when making investments. ESG factors have been shown to have an impact on the performance of investments, so it's important to ensure that you take these into account when making a different investment decisions. Now, the way we do that is, before we make investments or before we allocate our money to any particular company, is we make an assessment of all of the different environmental, social and governance factors that may impact the performance of that security. The environmental factors that we look at are really focused on climate change and carbon emissions, pollution and waste, as well as environmental opportunity and environmental access. The social factors that we look at refer to human capital and human development, product safety and product liability, as well as corporate social responsibility. And then on the governance side, the main focus is really on the overall corporate governance and corporate governance structures of each of the companies we invest in, as well as if the company is a good corporate citizen. These factors allow us to ensure that we're taking into account all of the different risks when we make our investments, and ensuring that the companies that we invest in are able to deliver sustainable returns over the long term.
Today at the Bifm Breakfast Seminar, we looked at a very interesting topic, exploring local alternative investments in the context of Botswana. So I think really in terms of as institutional investors, some of the problems that we've dealt with, or the risks that we have seen in the past with regards to the local markets, is too much cash chasing too few assets. And today, as we are dealing with the changes in pension fund investment rules, the biggest risk that we're still facing is that of too much cash chasing too few assets. And with the changes in regulations, some of the biggest risks that we are seeing is asset price bubbles, and really finding investable opportunities for our pension funds. So the question is, as institutional managers, what are we doing to address these risks? Just like with anything in life, with risks there comes also opportunities. We really believe that going forward, the alternative asset classes would play a key role in ensuring that these risks are adequately addressed. And from a Bifm standpoint of view, we have existing products which are channeled towards addressing these risks. In particular, the Bifm Local Property Fund from our alternative offering, and the recently launched Bifm Local Private Debt Fund. We believe that these two products will be key going forward in ensuring that some of these risks that will come with the changes in the PFR2 rules are addressed. And then in terms of other potential products that we are looking at the local private equity space as well as the infrastructure space. We believe that these asset classes in the long run would play a key role in ensuring that some of the structural problems we've had within the existing asset classes are adequately addressed. Thank you.